Hi everybody, I'm Anthony. Welcome to the channel. In today's video, we're just going to be talking about the price-earnings ratio, what it is and whether it's any good. The price-earnings ratio is one of the most well-known investment ratios around. It can be found in nearly every newspaper, quoted by many financial journalists, people like the FT Money, which is a fantastic publication by the way. But is it actually any good for predicting whether a share is going to go up in value or down in value? Let's have a quick look to see what the price-earnings ratio is, abbreviated to the PE ratio. It's simply the price of each share divided by the earnings per share. In other words, it's a measure of how the market values a company compared to its profits. So, by way of an example, a PE ratio of 10 means that the price is 10 times the profit or earnings per share. Or put it another way, the company's market valuation is 10 times its profit. On the face of it, this is a great way to quickly see if a company is more expensive than, say, another one. Clearly, a company that is valued 12 times its profits is more expensive than one that's valued at, say, 10 times its profits. Bingo! We can see if a company is cheap or expensive to buy. Where's the problem in that? To value a company based upon its earnings is a little bit like valuing a person on how much he or she earned last year. On the face of it, if somebody's earning £100,000 a year, they're going to be worth more than someone earning, say, £25,000 a year, right? Well, not necessarily. Would your opinion change if I said that the person earning £100,000 a year had to pay off their mortgage next month, had a car to buy next week, and had the bailiffs at the door demanding an overdue credit card bill, and that person only had £100 in their bank account? Compared to the person earning, say, £25,000 a year, who kept half of that cash each year and was sitting on the bank balance of £500,000. Now, who's the more valuable now? To base a valuation purely on earnings is not good enough. We need to take into account a bit more about the business to come up with a conclusion as to whether that company or that share is cheap or not. We need to take into account the balance sheet. Earnings figures can also be manipulated, and even though there are various financial conventions which differ from country to country to make the calculation a little bit more formulaic and comparable between companies, which earnings figures are you actually using? Is this a good idea? This is not altogether a bad idea. Value companies that have been established for years and years and years have a steady, predictable amount of profits. They bang out predictable growing dividends each year, can indeed have a PE ratio that means something. But growth shares, on the other hand, that may have never made a profit at all, or a very small one, but have the expectation of a vast profit in the future, will likewise have an astronomically high price-earnings ratio. Think Amazon, for example. Also, there's a very grey area between simply dividing shares into groups like value shares and growth shares. Many companies just innovate in their own way, buy in new technologies, expand their markets, buy other companies, etc., etc. To give you an example, AstraZeneca at the start of 2020 had a P ratio of 40, and GlaxoSmithKline, working in the same industry, had a P ratio of 11. So why would anybody buy AstraZeneca when you can buy Glaxo at a much cheaper price? But during 2020, AstraZeneca increased in value by 25% to a new peak in July. Glaxo, on the other hand, roughly decreased by 10% over the same period. Royal Mail had a P ratio of 150, yet has decreased in value by 100% in the last 12 months. What on earth is going on? I thought the P ratio was a good idea for value, I hear you say. So, is the P ratio actually worth anything at all? Its main use is to gauge what the market is prepared to pay for past profits. And as we all know, past profits are no indication for future profits. Therefore, it's probably fair to say that the PE ratio is what the market is currently prepared to pay for the expectation of a future profit based upon a previous profit. But the big problem with the price-earnings ratio is that it uses the earnings figure at all. Earnings look nice, but what the company really relies upon is cash, money in the bank, and the ability to make and keep it there. The problem many people and companies have is confusing profit with cash. It's too simplistic to believe that cash follows profit, which leads on to the second major problem with the price-earnings ratio. The company may well be profitable but be running out of cash. I've seen this countless times when I was running my distribution business. Some of my customers were very profitable but undercapitalized, which basically means that they didn't have enough day-to-day cash to pay for short-term liabilities, e.g. a tax bill, a machine replacement. Companies need to service pension fund liabilities, buy assets to replace out-of-date equipment, service debt, etc., etc. In summary, the P/E ratio does not take into account the balance sheet of the company and in particular the debt component. Companies that have a price-earning ratio of 5 may look much cheaper than a company with a price-earning ratio of, say, 15. But delve into the accounts and you may find the company with a P/E ratio of 5 is just about to go bust because it can't afford its debt. The market therefore values that company's shares less, even though the two companies may be making the same profit. In the same vein, what happens if one company makes an exceptional profit in one year that's unlikely to be repeated the next? The market does not expect those profits to be repeated and therefore discounts exceptional profit items, leading to a temporarily low price-earnings ratio. In the case of AstraZeneca and Glaxo, AstraZeneca's high valuation is partly due to its pipeline of forthcoming drugs, its high profitability of its oncology division, that's cancer, and the market's faith in its proven CEO. Glaxo, on the other hand, concentrates on virology, and during the pandemic, there's been an argument that demand for its products has decreased whilst the world concentrates on treating COVID. This leads on to the final problem with the price-earnings ratio, in that the P/E ratio of, say, 150 in the case of Royal Mail means that the market expects to pay 150 times the profit per share for that company. In other words, it's going to take, in theory, 150 years to get my money back based on last year's profits. Who on earth can predict a company's profits and performance for the next 150 years? It's hard enough to predict next month, not alone next 150 years. Anything could happen. So in conclusion, the price-earnings ratio is often used but seldom used in isolation because it's a very narrow indicator of one specific profit figure compared to the current share price. There are better price indicators than the price-earnings ratio, and one could be the enterprise value of the business divided by the earnings before interest and tax. The enterprise value is essentially the market value minus the net debt of the business. So at least it takes into account some of the balance sheet that the P ratio doesn't. And the earnings before interest and tax and amortization, shortened to EBITDA, quite often see that in financial press, attempts to look at the earnings or the operating earnings of the business, and many argue that this ratio is a much, much better useful indicator than the P ratio. But it is harder to find, but we'll have a look at that in another video. Anyway, that's it for this video on the price-earnings ratio. I hope you've liked it. Thank you very much for watching. If you've enjoyed it, hit the subscribe button and the notification bell, and you'll get an update when I next post the video. Bye for now.